Thanks a lot. You're watching TVC Breakfast. The International Finance Corporation and the Central Bank of Nigeria have signed an agreement to increase local currency financing. The move is aimed at not only improving local currency financing for Nigerian businesses and reduce foreign exchange risks, but it should also help private businesses in the country grow and thrive. The IFC is a World Bank Group member. It aims to significantly scale up its financing in Nigeria, targeting more than $1 billion in the coming years. And this CBN-IFC partnership will enable the World Bank arm manage currency risks and increase its investments in Nigeria's naira currency across agriculture, housing, infrastructure, other sectors, as well as energy, small and medium-sized enterprises, and the creative industry. That's what we want to talk about now. We bring in via Zoom Group Managing Director and Chief Executive Officer, Cowrie Asset Management Limited, Johnson Chukwu. Good morning. Good to see you again.
Good morning. Thank you for having me.
Indeed. Welcome. Welcome to the program. How optimistic are you about this partnership?
Well, I'm always an optimistic person. The key thing I understand the economics behind what IMF and IFC and Central Bank are signed. So given that, I think it is doable. And basic thing is that IFC wants the Central Bank to kind of give them some level of currency risk insurance, kind of to say, look, I'm going to lend to Nigerians in naira. Of course, IFC does not trade in naira, so IFC trades in dollar. So IFC will provide dollar funding that will be disbursed as naira loan, and the Nigerian entities will pay back in naira. But the central bank will guarantee IFC that they will get the same value of dollar when the payment is made, because the currency is depreciating or devaluing. So if, for instance, IFC lends to you $1 million maybe a year ago, and that $1 million officially was 460 million naira, today you need to pay about 1.6 billion naira to pay that $1 million. And ordinarily, most Nigerian businesses will not be able to pay 1.6 or 1.7 billion naira for a 460 million naira they took. So what IFC is saying that central banks should stand in the gap and provide some assurance that, look, when these Nigerian borrowers pay back, you will convert back this to dollar in the same value that we have provided with the margin, with the low interest rate that IFC also will provide, or relatively low interest rate. So I think it's doable. I can see the opportunity. The key thing is that the central bank must have a war chest or the liquidity or the reserve to guarantee such dollar loans in terms of exchange rate.
Does it look like we have it?
Well, today, the central bank governor said we have about $40 billion in reserve. And the total amount of this exposure in a few years will be $1 billion only. So I think it's quite within the limits of the central bank capacity to fund. I don't think that amount is too much for the central bank to guarantee in terms of currency exchange rate stability. So what they're basically going to do is to say, look, I'm bringing this money in at 1,700. In 1 year or 2 years' time, when the loan is paid back, you convert it back to me at 1,700. So that's basically, so the CBN goes into a forward deal and locks the price and puts aside that funding.
Okay, so, excuse me. In the past, there have been several policies aimed at improving the lives of people, improving businesses and all of that. What's the difference between this one and every other policy that we have seen in the past?
Well, it depends on which policy you're referring to. Of course, this policy is not targeted at, basically, it's not primarily said it's going to improve the living standard of Nigerians. Of course, if economic activities improve, if businesses can borrow at relatively cheaper cost, it will help improve productivity, which will lead to improvement in employment and improvement in income, which will ultimately improve the standard of living of Nigerians. There are policies that are targeted at intervention. This is not an interventionist policy. Those policies are what you may call the government's primary objective is to improve the living standard of people or to cushion the adverse economic situation, such as the conditional cash transfer the federal government had. Those are directly targeted at those at the bottom of the ladder, or the rung of the ladder. But this policy, IFC, is a private sector arm of the World Bank. Its credits are relatively more expensive than the interventionist or development finance credits. Their credits are relatively priced at commercial rates you will get from international banks globally, maybe marginally below that. But the key thing in this time around is that they, being an arm of World Bank, will go to sectors that require some level of intervention. Like what they mentioned, agriculture sector requires some level of intervention. Agriculture accounts for more than 22% of the GDP. It grew at only 1.41% in the second quarter of this year, which means it's growing far below its potential. Look at infrastructure. We have one of the highest infrastructure deficits in the world. You look at areas like energy sector. I mean, it was reported yesterday that most northern part of the country have been on blackout. For those of us in Lekki, we were on blackout for more than 4 days. We have severe energy deficiency. Look at growth sectors of the economy like the creative industry that is not getting sufficient funding. So that's where the IFC come in, and where they can actually say, we have this underdeveloped country. We are going to intervene in sectors that build growth opportunities, where those sectors ordinarily will not be able to get funding from international financial institutions.
Okay, so in all you have said now, how would this aid the federal government diversification drive and also catalyze the sustainable growth of the economy?
You know, in the first place, look at those sectors which I mentioned. If you talk of diversification, you will realize that apart from the agriculture, the oil and gas sector, which account for 91% of our total export, the agricultural sector, with its 2% or so, is second contributor, followed by beverages and alcoholic drinks. So if you expand the agricultural sector, particularly the exportable value chain of the agricultural sector, you are going to help the country diversify its foreign exchange earnings. The other areas that had creative industry, the creative industry seems to be the biggest export Nigeria has today in terms of brand, as our brand ambassadors, in terms of, when I talk of biggest export, I'm talking of in terms of burnishing our image, global image, in terms of creating awareness about the country. So, and it's also one of the major employers of labor. Then the other sector, like infrastructure, you and I are fully aware of the debt of critical infrastructure. So if you build infrastructure, you provide enabling environment for productive activities. All these things will contribute to diversify the economy, improving our foreign exchange earnings, and helping us stabilize the macroeconomic environment.
Right. And, okay, so if you look at the trajectory of IFC's investment in Nigeria, how would you weigh the value that they are bringing in at this time?
You know, we have to first recognize that IFC and World Bank, the IFC, like I mentioned earlier, which you also did say in your introductory statement, is an arm of the World Bank. The IFC World Bank Group are the second largest lenders to this economy, after the commercial credits, which in form of Eurobond, which is about 15 billion, about 42 billion foreign currency loans. So the World Bank Group had been a major support base in terms of funding for the country. And I think this is in addition to an addition to what they are providing. So if you are put in that context, we would say that, look, in the first place, we recognize that any lending that is coming at sub-market rate is something to celebrate or something to appreciate, particularly for a country in severe need of foreign currency inflow. Remember also that this $1 billion, when it comes in, we add to the inflow in the economy and help moderate the pressure on the exchange rate.
All right, and you don't think it is fair to label World Bank as meddlesome, as some analysts have called it?
Well, there's, what they say in America, there's actually no free lunch. So I don't consider them a medicine. You go to somebody and say, these are my conditions to advance money to you. If you need that money, you have to recognize and you have to abide by the conditions that are specified. A lot of the conditions that the IMF presents to developing countries are designed to make them be more prudent. Some of them may be philosophies, economic philosophies that have not been tested in the past, like what we had. The structural adjustment program of the IMF was not tested. They felt that theoretically it was sound, but in terms of implementation, it needed to have been modified to be attuned to the peculiarities of each economy. So what happened then in the 80s was the IMF World Bank developed the IMF World Bank developed the one size fits all, and they tried to apply it across countries. But countries that had stronger leadership and stronger economic managers were able to modify the prescriptions of IMF to suit their peculiar needs. I've always said that economic policies must be homegrown. Homegrown in the sense that even if you are getting input from any advisor, it must be aligned to the peculiarities of your environment. Each environment, economic environment, it has its own peculiarities. Ours does. And so when people talk about IMF, they are saying that IMF is asking you to swallow a bitter pill. For instance, IMF say remove the subsidy on petroleum products, harmonize the exchange rate. In doing that, you also recognize the peculiarities of your environment. You also recognize that harmonizing the exchange rate, you have to stimulate productive activities, because if you do not produce more exportable goods, if you do not build an economic base that can produce and export, even when you harmonize the exchange rate, you are not going to shift the north in terms of foreign exchange earnings. So what will happen is a massive depreciation that we've had. So, but if the government had actually thought through that, they would have put in some safeguards to moderate the impact of the naira devaluation. And I think the basic thing we have to bear in mind that an advisor gives you an advice. It is left for you to recognize your peculiar situation and take the advice to an extent that is relevant and profitable to you.
Right.
All right. So IMC is saying that it aims to significantly scale up its financing of critical sectors in Nigeria. Now, they have a goal of providing more than 1 billion naira in the coming, $1 million rather, in the coming years. My question is, what do you think is in it for IFC and the World Bank?
The IFC, like I said earlier, is the private sector finance arm of the World Bank. It was set up or still as an interventionist agency. The World Bank's primary objective is to improve global living standards, to improve the capacity of countries to trade, to ensure some level of equity in the global political and social environment. Mm-hmm. So some of these World Bank, IMF policies and IFC, which is an arm of the World Bank, are intended to support countries that are struggling, to support countries to develop infrastructure. So their benefit is that it's in tandem with the primary objective for which they were set up. To remember, the World Bank was set up after the Second World War to rebuild the countries that were devastated. And subsequently, its objective was expanded to intervene in countries that are developing. So this is just in tandem with their primary objective.
Right. And well, World Bank and the IMFs of this world still label our naira as one of the worst performing currencies, even in Africa. But, you know, I think over the past few days now, they say, okay, the naira is, finally showing, some form of strength and how it can bounce back. Tell us what you think, really.
Well, to say that our currency was one of the worst performing in Africa or globally, well, just reporting facts. It's just to say, look, despite the situation you found yourself, you came last in the class. So it's not a judgment call. It's just a reporting facts. It's not that they are judging our college. They're just telling us where we are in terms of ranking. When you talk of the movement in your exchange rate, our local currency has lost about over 70% in the past 10 months. Remember, the currency closed about 907 naira to $1, at the NIFM window, that is official window, and about 1,206 naira to $1 at the parallel market window. Today we are talking about 1,740 naira to $472 at the parallel market rate, and over 1,600 naira at the official window. So what they are stating is fact. But in terms of the currency gaining strength, I'm not aware the currency has gained strength in the past few days. The key thing we have to bear in mind that the central bank must recognize its primary objective to maintain price stability, including currency stability. It is not enough for the central bank to say we are building reserve, we build reserve back to 40 billion. The most important thing that the market is looking out for is that there must be a stable supply of foreign currency or any product in the market has to meet demand or relatively clear demand to maintain price stability. If you create artificial scarcity because you want to accumulate your reserve, you create some level of doubt and uncertainty in the confidence of investors on or market players on that currency or that product. And then there will be need for people to acquire to make sure that they do not suffer exchange rate loss or price movement against them. That's what the central bank must recognize. It would have been good if the central bank was supplying the market relatively stable volume of foreign currency as to maintain market stability. The reserve you have built to 40 billion without meeting market demand does not give anybody confidence. I think that's what we should take away from this conversation.
And if it's not giving the people confidence, how do we have investors come in? What can we do to mitigate all of this?
Well, when you talk of investors coming, I want to believe that you're referring to long-term investors.
Yeah.
There are several factors we have to deal with. The currency stability and currency availability is just one of those factors they consider. They look at your infrastructural support, they look at security situation in the country, they look at your policy environment, they look at the political environment. They generally carry out what they call a sovereign risk assessment of your country, which takes into cognizance some of these factors I mentioned. And then they will judge you to see if you are a good investment destination. They also look at how is your economy growing, what is the purchasing power of the citizens, consumption power of the citizens. The alternative is that they can also come to you and say, I just want to set up manufacturing outfits. You don't even have the market for consumption. So, but I want to manufacture a place because labor is cheap, power supply is stable, power cost, the energy cost is cheap, transport, I have transport infrastructure to take my goods to the seaport and export them. And then if I have all this and I have security and I have a legal system that will protect my investment, if I have this, I've just set up manufacturing outfit in your country and export to that country. That's what's happening to places like today, Vietnam. That's how China started, where the global, it turned to be a global manufacturing base, where companies went to China to produce because of cheap labor, because of efficient and cost-effective infrastructure, and they were exporting to other countries of the world until China's consumption or income level grew and China turned to a big consumer market. But Vietnam today is taking that position. We've seen global investors diversifying away from China, going to India, probably because of the supply chain crisis they had after the COVID issue. And they're saying we need to diversify our productive base. And Nigeria, ordinarily, with the population of over 220 billion, a youthful population, average median age about 17.8 years, should ordinarily be one of those destinations if we can fix the infrastructure, fix the legal environment, fix the security environment.
All right, so let's pan our attention now, while we still have a few more minutes before the end of this interview, to the oil sector. If you look at the papers this morning, that appears to be like one of the most prominent stories. First of all, the president still talking about hopes that the naira for crude oil transactions will stabilize the market first, and then the naira. What are your thoughts, Mr. Chukwu?
My thoughts are that for the crude for naira contract that the federal government has signed, or NNP has signed with the Dangote and other local refineries to stabilize the economy, we need to improve crude production so that we do not have a zero-sum game situation that we have today. The zero-sum game situation we have today is that whatever crude we give to Dangote or any of the local refineries, is export that is forgone. So your foreign exchange earnings from export also reduces. Remember that PMS, fuel, account for only 23% of our total import, 21% of our total import. So if you give out 90% of your export products to save 21% of your import, you will be in crisis. Total import of refined petroleum products is about 35% of our total import. So at best, you say you want to save 35% to forgo about 91% of your foreign exchange earnings. So back to the issue I was saying, the key solution is we need to increase crude production so that whatever crude that we give to the local refineries is from incremental crude production so that we continue to maintain our current 1.4 million, 1.44 million barrels daily crude export or thereabouts. That way, we will save the 35% of our current import bill, and possibly this local refinery will even export part of their refined petroleum products and earn us additional foreign exchange earnings. So that, for me, is a route to addressing that problem. Without increasing crude production, to achieve incremental volume that will go to the local refineries, we will, unfortunately, be, like I said, in a zero-sum game, where what you gain in one, you lose it from the other end.
And it has also been suggested, I wonder what you think about that option, that another way or a low-hanging fruit at this time while we talk about strengthening the naira will be for the Dangote Refinery to expedite importation of its commodity to countries that have stronger currencies. Do you think that will work also?
That's to expedite export of its commodities.
Right.
Ordinarily, Dangote is a businessman. If he sees export opportunities, he will latch onto it. But remember that the refinery business, the downstream refinery business, is one of the most complex industries globally. In the first place, margins are very thin. They are major traders that are competing within the African space. I was happy when I saw on the news yesterday that Ghana is considering importing fuel from Dangote. I'm hoping other countries, other import-dependent countries will also import from Dangote. But the key thing is that Dangote is competing at the global market space with refineries elsewhere in the world. Refineries that are taking crude from Saudi Arabia, refineries that are taking crude from Iran and Iraq, refineries that are taking crude even from US, because US is today the largest crude producer in the world. So, and these refineries are probably, Dangote has to be sure that he can compete with them in terms of cost of production. And I hope being a new refinery, he should be able to do that. But bear in mind that Dangote as a businessman will look and will continue to look for export opportunities and will latch on to them whenever they present themselves.
But then he's also saying now that marketers and NNPC ought to stop importation, crude importation. Is that, something that he can champion? Is that even workable?
No, the marketer should stop importing refined petroleum products because he has enough fuel. That's, when I hear the statement, I've been turning it over in my mind. I've been trying to make sense out of it. The key question I ask myself is that ordinarily, being a refinery located in Nigeria, their cost or their factory cost or refinery factory cost layer should ordinarily be cheaper than the landing cost of imported fuel. So if that be the case, there's no logical reason why anybody will import, unless the reverse is the case. Because in the first place, even the traders are looking for profit. So if, for instance, I can buy from Dangote at 700 naira per liter, why would anybody import and land at 900 naira per liter? So I'm still interrogating the logic of what is happening between Dangote and the Nigerian marketers, including NNPC. I believe that the marketers are looking for profit, and they will buy from whoever we sell to them at the lowest possible cost, so that they can make, because it's a low-margin business, a high-volume, low-margin business. So I can relate with the logic. I'm trying to wrap my head around the logic that these people are not buying from him when he has more than 1 billion liters in his tank.
So do you expect
but I
Dangote to
that
reduce his price?
was made before the president, and the NNP's officials were there. The marketers must also have been there. And I think between the three parties, NNPC, Dangote, and the marketers, they should be able to tell Nigerians what is the issue. Is it that Dangote's refined products are more expensive than the landing cost of imported products? And if it is, what can be done to make it cheaper so that Nigerian importers and NNPC will rather buy from Dangote than import? But I believe the logic behind anybody buying from any source is all about what is the landing cost to me. Would this cost allow me to make even a marginal profit so that I remain in business?
Do you think Dangote should reduce the price of his product, looking at the fact that the petroleum products are largely dependent on the international market? If he reduces his price just to meet local needs here, will he make profits?
You know, when you talk of business operation, you can't just sit in the comfort of a studio and say, I can't sit in the comfort of a studio and say he should reduce his price. I don't know his landing cost. I don't know, but what I only know is that the federal government said they will give him crude in naira. But I also want to assume that the crude being given to him is also marked to global crude price, and exchange rate are ruling at the point when the crude is given to me is what is applied. So he has to deal with the exchange rate movement. And like I said, I don't know his overall cost of production. But the key thing that we must bear in mind that it is a competitive market. Like I said, the refining business is a low margin business. It's a very competitive business. You have global traders as well who also have refineries in other parts of the world who are also trying to compete. So for a business person, there's a book we read years back, it called Blue Ocean Strategy, that if you can provide a superior service at a lower cost, you create a blue ocean that nobody can compete with you. And that became a strategy that many of us in business, we are trying to strive to achieve then. So, and I believe Dangote is fully aware of that. If your products, like he said, in terms of ppm, he has one of the lowest ppm. I think he said it's 10 parts per million that his PMS or his AGO is coming at. And if the same thing applies to his PMS, then that means he has a superior quality. And the next thing is that is he producing at a lower cost? So if he combines both, given that he is already very proximate to the consumers in the sense that nobody has to pay a major shipping cost to bring it from Western countries, from Netherlands, from Malta, from wherever to Nigeria, he should have a cost advantage. And if he does have a cost advantage, he should exploit that cost advantage and make sure that he is selling to the market at prices that are lower than they can ever get from any global product marketer. And that way, the marketers have no choice to buy from him, but the marketers will beg him to buy from him. But if the reverse is the case, then he will have to apply some moral suasion or political pressure to prevent marketers from buying from sources that are cheaper for them if they can get the product cheaper. But remember, the market is a deregulated market, and that's where that we all have to recognize.
All right, Johnson Chukwu, it's a fine place to leave our conversation. We thank you very much, Mr. Johnson Chukwu, who is the Group Managing Director and Chief Executive Officer of Cowrie Asset Management Limited. Many thanks for speaking with us.
Thank you for having me.
Right, and when we return from this break, we'll turn our attention